Hi all and welcome back to another episode of the ICIS Energy Foresight podcast. We are recording this during the summer break when, unlike the past 2 years, energy markets seem to be quite calm, something we're now longer used to. So we thought that this is probably the best time to take stock of what has happened over the past 6 to 8 months and touch upon what's coming and what awaits for us after this summer break. We are recording this just right after Trump and Putin met in Alaska to discuss the peace agreement for Ukraine. The first in-person meeting failed to make any concrete breakthrough in the process, but in the aftermath, interesting enough, President Putin signed a decree which opens the door to ExxonMobil to potentially return to the Sakhalin-1 oil and gas projects. A sign that lifting Western sanctions against Russia may be something coming or potentially on the list. But let's go in order and take a step back. And for this, let's say, overview, want to change a bit things instead of just looking backward and forward. I want to apply a different lens to the exercise and try to look at energy markets in terms of what has not changed and what is changing. So if we look at the two buckets, what is not changing and what is changing, on the left-hand side, what we have is geopolitics and policies that are constant, and that is both are closely linked to a high level of volatility, a price volatility that is also remains quite of a constant. What we are seeing also is that the demand is not picking up, so demand is still quite depressed. On the new elements, which are proving to be quite interesting and might be quite impactful, what we're seeing is that obviously trade war is the new game in town, the new driver. There's a level of oversupply which is impacting a few markets. We will look into that. And then there's a slowdown in green investments in certain areas of the world. But at the same time, we are seeing new technology which is emerging as a strong complement, which is batteries. Now, if we start from geopolitics remains the big driver. We have now multiple conflicts running across the world. And the escalation of the conflict in the Middle East with the attack of Israel to Iran during the spring has taken the geopolitics to a new level. And while we can say that the closure of the Strait of Hormuz is not on the table or remains not like a real possibility at the moment, the global energy supply chain remains at risk of disruption, creating a massive level of uncertainty. On top of armed conflicts and sanctions, the US gone a step further, proposing the full phase out of Russian energy import in this year, which is something that it should happen in the European spine over the next 3 years. And this takes us to policy, which remain another constant. The main policy element of the first half of the year is probably the relaxation of the European gas storage targets, which was a major catalyst in bringing down the price of TTF during the spring. If we look outside Europe, the US is unsurprisingly, what we are seeing in the US is the rollback of all clean energy initiatives by the new Trump administration. And while we don't see that still appearing in energy figures, there's definitely slowdown in terms of investments in this space. We will look at it in just a second. And finally, what is happening on the oil side with the rollback of the 2.2 million barrel per day output cuts by the Saudi and the other OPEC members is starting to have an impact on the market. And we're starting to see the effect on Brent of the recent ramp up just now. And all of these keeps preserving a level of price volatility, which is way above historical averages. And while we have not touched the highs, the record highs of 2022, the first 8 months have seen huge swings in prices across all major energy commodities. So we started the year with a lot of pressure on the TTF on the back of an expectation that gas storage would end the winter year at very low levels, and that we were basically going to a similar summer to the one experienced in 2020-22. That effectively didn't happen thanks to a relaxed gas storage target, as we just discussed, and also to a first glimpse of a peace deal between the US and Russia around Ukraine, which opened up to the possibility of a return of Russian gas also through the Nord Stream, which obviously is now materializing. More volatility appeared when Israel attacked Iran, and that pushed the price of oil above $70, dragging gas and carbon along. But policy and geopolitics are not the only drivers of volatility. With the increasing share of renewables, we now have weather-driven volatility, and we are now all very familiar with terms like Dunkelflaute and Heiße and effectively this year we are already experiencing a record number of negative prices, which obviously are conditions of let's say high penetration of renewables and a time of low demand. And we're seeing also record peak prices when renewables disappear and conventional plants need to step in. Lastly, on the energy demand side, while the big story of 2024 was rising power demand linked to data centers that we still have to see in numbers, consumption data, the story for 2025 is a story of weak demand. That applies across all main markets. Oil and gas demand growth is weaker than expected, both in the United States, in China, but also in Europe. That is linked to weaker than expected global economic outlook, linked to trade negotiations and trade tensions, but also to some of the underlying factors that are playing a role in terms of electrification of developing economies like China. Now, let's move on the other side of our table and look at the factors that are changing and new elements that we need to keep track of and understand better. The first one, obviously, is the new game in town, trade tariffs. April the 2nd, Liberation Day, is probably the starting point of a new chapter of the global economy. The introduction of US tariffs on imported goods caused massive sell-off across all main energy markets, pushed the price of oil to a 4-year low, and unsurprisingly, it triggered a immediate reaction from China, which retaliated, stopping all import of US LNG straight away. A move that is not new and that we saw already like a few years ago during the first Trump's term. We have created a topic page specifically on the trade war, which is accessible to our own page and keeps track of all the latest developments and provides an impact of tariffs on chemical and energy markets. If we look at the second big change, which is unfolding in front of our eyes, is the looming oversupply. It's not any news for the chemical market, which has been in an oversupply for the past few years, but it's definitely a new factor in the energy sector, which both affects the oil and the gas market. What we are seeing, without entering into the dispute between the IEA and the OPEC around peak oil, what we're seeing is obviously increasing oil production coming from OPEC, which is keeping a lid on prices and pushing the oil prices down, which is good news for obviously the inflation side of the economy. And at the same time, on the gas side, what we are seeing is that the high prices of 2022 and pipeline that was already building there is now resulting in a lot of new investments that are coming to market and a lot of new liquefaction terminals that are starting to produce new LNG. Just this year alone, by the end of 2025, we expect roughly 35 million tons of new LNG capacity that will come to market, and more is just around the corner in 2026 and 2027. We have published white papers specifically on the future of LNG, of the LNG market, looking at the looming oversupply and how that is gonna affect global gas prices in the years to come. The green investment slowdown is probably a bit exaggerated as a term, because we're still seeing green investments happening globally. There is a disparity because China is still driving that, and unsurprisingly, the new Trump administration has put a new spin on the whole energy transition, rolling back a lot of the policies on clean energy that the previous administration put in place. What is interesting, though, is what's happening in Europe. For the first time since COVID, the European Union or European member states are projected to install less solar capacity this year than last year. And we see that the struggle is also on the wind side, as recently shown by the failed auction in Germany for two offshore wind sites in the North Sea for a total capacity of 2.5 gigawatt. A mix of factors are playing a role here. Investment costs have got higher. The permitting is still quite lengthy, even though there are pockets of efficiencies emerging in a few areas. But more importantly, there are two big question marks around capture prices and curtailments, which are now looming on all investors and developers. Something that is new and that was heightened this year when after the Spanish-Portuguese blackouts, and then put the attention on curtailments. We are seeing a record number of curtailments all across Europe this year, which is a countermeasure that TSO, transmission system operators, are using to make up for a lot of congestions across the different nodes of the grid. On top of this, we have obviously negative prices, and we have run a few analyses on negative prices and specifically the impact that this might have on the forward curve and hedging strategies going forward. And the response of it, and this is the last emerging element, is coming from the market in the form of new investments in batteries. And the obviously increasing of currents of negative prices and peak prices are opening the door for the battery case, providing a strong economic case for this technology, which, coupled with the slashing battery costs, is basically prompting a new wave of investments. And overall, we see that in Europe, installed capacity is on track of being, let's say, 40% higher compared to last year. And this is definitely a new element that will reshape the future functioning of the European power market. So what can we expect after this summer break? As we've seen, a bit more of the same and some new trends there starting to emerge. Important dates. while there is no set date for the Ukrainian-Russian negotiation process, there is now, as we are recording, a meeting between European counterparts and the US administration to discuss the aftermath of the Trump-Putin meeting. So we can expect something to happen over the next few weeks. But I think if we look at Europe and we look at what is scheduled on the beginning of September, on the 4th and 5th, the new Danish presidency will host a first informal energy meeting. And then at mid-September, we have meeting of the environmental ministers that will discuss the 2040 climate target. In October, there's going to be the discussion around the phase out of Russian oil and gas. Probably we see more of that being discussed over the next weeks. And again, for everything that you guys want to know and everything that is gonna impact the future of the energy markets, we are on top of it with Energy Foresight. You have all resources available at our website, our portal, or reach out directly. For now, that's all. Hope you've all had or having a great summer, and till the next time.